framework does call for a rate rise, but I'm agnostic on exactly when we do that. I do like to move on good news about the economy. So if we got to a meeting and we felt like things were looking stronger, that might be a good time to do that.
Have we had enough good news in the economy of late?
We had a couple of good jobs reports here, but year over year GDP growth rate is very low, below trend really. And the thing about that is you can't blame that on seasonal adjustment.
If you do it year over year,
yeah.
Right? So we're looking at your forecast here, and it calls for 2% growth. And I
that's
assume,
over the forecast horizon,
which is 2.5 years.
Yeah.
But can we do 2% this year? Because if you do, you got to do 3% in the back half.
Yeah, some of the tracking forecasts are up a little bit. They're up around 3.
Yeah.
So if you had a 3% second half, maybe you could get to 2% growth for the year. But
So-
that kind of says something.
So
doesn't
one
it?
more
Yeah.
short-term question: is that rate hike something you could do this year?
We could, but like I say, we're kind of agnostic about it. The important point is not that there's a rate hike. The important point about our framework is that there's a rate hike, but there's not this on the cusp of 200 basis points
Which
story,
is the Fed forecast.
which is the story we're telling in our dot plot, and that's what I'm trying to break down. We don't have anywhere near that kind of certainty about where the long run outcome is for the U.S. And so what's happening is people are putting in their Taylor rules, and then they're saying, well, gaps are about 0, rates have to go back to normal levels, which is some sort of average of the past. This regime idea says, well, we're not exactly sure where the economy is heading. So what we're going to do is make the right policy for today's regime, which is very low real interest rates on government paper and very low productivity, a slow growth, low inflation economy. And we'll make policy right for that. That's kind of an imperfect adjustment. I think I've got a better framework for how to think about it.
Right.
You just think about the next 2 years. What are the parameters that are governing the next 2 years, and make policy right for that, and don't say too much about the long run.
What if you're wrong about this? I mean, the concern is twofold. We hear from other Fed officials. One is that you have these bubbles in asset values and prices. That's one.
Totally fair. There's nothing about asset bubbles, so that has to be handled judgmentally. That's outside the forecast for us.
Outside the forecast, but it could be your rate that's fostering it. I mean, if people who said that the whole financial crisis was caused by rates being too low for too long.
I mean, the model I described doesn't have anything about asset price bubbles. So you gotta. Most models don't have actually anything about asset price.
That,
but a typical forecaster doesn't have anything about that.
But that's one of the reasons why we hear people like Esther George, even Robert Kaplan yesterday, say
totally
rates should go up.
That's totally fair.
So you're ignoring that?
I'm not ignoring it. I'm saying for forecasting purposes,
Right.
I'm writing down a baseline forecast. It's assuming no bubbles, and I'm going to have to make a judgment about whether I think we're in bubble.
What is your judgment on that?
I think we're fairly valued, or on the high side of fairly valued, and I could see the process getting away from us. Maybe tech stocks, maybe others. I don't know.
Uh-huh.
Yeah.
What about bonds being overvalued? The idea that there's a huge bubble in bond prices.
Right. So our framework does have that because we think the real interest rate on government paper is extremely low.
Right.
And why is it so low? Well, we're kind of agnostic about it, but we say it's because there's a big liquidity premium globally, and that is pushing the 1 year ex post real rate of return on U.S. Treasury minus 135 basis points over the last 3 years. It really hasn't moved over the last 3 years. So what we're saying is, for forecasting purposes, do you think that's going to turn around anytime soon? No. When I talk to people in markets, no. So you should just take that as a parameter, and then you should go ahead and make your right policy.
Is there damage being done by the Fed in terms of forecasting these higher rates, these 200 basis points of tightening in its forecast?
Yeah, I think that's hurting our credibility. We're 2 years, about a year and a half, but by the end of this year, we'll be 2 years into the process since QE ended. Maybe have moved twice by that point.
And you keep getting it wrong. You keep telling the market you're going to do more.
So I think that's affecting global pricing. You've got this policy divergence story, which has been in FX markets for a long time here. And so, yeah, I think it affects the pricing. We want to line that up better with what is a more realistic assessment of what's going to happen over the forecast horizon.
And speaking of realistic assessments, we had up earlier our Fed funds survey, or Fed survey forecast for the Fed funds rate. the Fed keeps coming down to where the market is. So the market is giving a more realistic view of where rates are headed than the Fed has gone.
But the market agrees with me. One of the things that we put in this is that there is upside risk, I think, to our forecast. So there is some possibility. We don't really believe in the Phillips curve. If you look at the empirical evidence on it, it's
Right.
pretty weak. Those effects are pretty weak. We've got a pretty strong labor market over the next 2 years, but we're saying that's not going to generate much inflation. It could be that the Phillips curve reasserts itself and comes in with a lot of firepower, and that drives inflation higher. If that happens, we're going to have to react.
Speaking of labor markets, and then sort of also the political system, the Wall Street Journal had a story yesterday saying it's been Fed policy over the last several years that's helped foster some of the political divisions in this country and some of the political landscape that we have right now. How do you respond to that?
Well, the Fed has been in the middle of the response to the big crisis, but I think we're at the end of the era for that. Unemployment's down below 5%. Inflation's a bit low, but it's not that far from our target. So I think monetary policy on the whole has ended up doing pretty well. And we're going to need a medium-term growth agenda for the U.S. economy, which focuses on productivity, focuses on GDP growth, and there are many things that need to be done, better investment, for instance, but many other things that need to be done to get GDP growth higher in the medium term.
But those are on the fiscal side.
It's got to be a 5-year kind of idea. It can't be stimulus. I've sometimes talked about banning the word stimulus because it gets everybody thinking about what's going to happen in the next quarter, what's going to happen in the next 6 months. You got to take a longer term perspective and think about what kinds of policies can we adopt as a nation that will get the growth rate up.